what's up guys? You got Curtis here with Long Trend. Today we're going to take a look at an interesting company, Lam Research Corporation. Active since the 1980s, they've become a key global supplier of wafer fabrication equipment to the semiconductor industry. So what's a wafer? Well, here's a picture of one from Lam's most recent investor deck, which I've linked to in the description. Just as it looks, a wafer is a very thin slice of semiconductor material that microelectronics are built upon. Lam sells its equipment and services to major global players like Intel and Taiwan Semiconductors. This company is a supplier in a fast-growing and increasingly important market. You would have heard recently that there are global shortages for computer chips as demand for computing power increases. As of this morning, November 5th, 2021, Lam is trading at 16 times enterprise value to EBITDA and 20 times price to earnings on a trailing 12-month basis. In my opinion, these look like reasonable and fair multiples to pay for a company that's quality and in a sound financial position like Lam. Okay, so today what we'll do is we'll pull Lam into the model. We'll look at its revenue, we'll look at its cash flow, and we'll try to determine if investing in Lam today has merit given that its stock price has run up recently. Okay, so if you're ready, let's get into it. So a few things about Lam Research Corporation. They're a $600 stock, they've got 140 million shares outstanding. That's a market capitalization of $85 billion, and they have no net debt. So that means enterprise value is the same as market cap. They're currently trading at 16 times enterprise value to EBITDA. Historically, they were at 12 over a 10-year period, 13 over a 5-year period, 15 over a 3-year period, 19 at the end of last year. They had a material increase in their enterprise value from 2019 to 2020. That was on the back of significantly higher earnings. So their earnings actually went from 2.2 billion up to 3.9 billion. So significant growth in net income and EBITDA. Okay, so this company doesn't have a debt problem. In fact, they could actually use debt to help them grow if they wanted to. They don't look like they have a significant appetite for debt. It looks like they're happy with that capital structure. So if I was on Lam's executive team, I'd be thinking to myself, wow, what a good position this is. We're making 3 billion in cash flow per year now, and we're looking at an increasing demand for our products over the next decade. That's a great position to be in. Okay, moving down into the operating assumptions, let's quickly look at revenue and how it's evolved over time. So revenue in 2010 was 2 billion, then it was 5 billion by 2014, then it was 8 billion, then it was 10 billion, and this year they did 14 billion. From a growth perspective, that means they've grown their revenue at 16% annually over a 10-year period, 20% annually over a 5-year period, 10% over a 3-year period, and 46% over the last year. The question to ask next is, will that continue? The way to figure that out is to go check out guidance. So if you look at the December quarterly guidance, they said that they're going to do 4.4 billion for that quarter. If I annualize that, that's about 18 billion a year. So that means they're going to grow their revenue again by 20 to 25% this year. And this, coupled with a heated market, is what has doubled their stock price. Okay, but just because the stock price has doubled recently doesn't mean that this thing isn't necessarily a good investment. It just means that you have to invest with your eyes open, understand potential growth, and model the downside. So what I'm going to do for Lam Research is in the first year of my forecast, which is going to take me a year out from now to 2022 September, I'm going to make it 18 billion. Which means I'm going to put 14% here. And then what I'm going to do is I'm going to scale growth down to 5%. Okay, so in the forecast, I'm saying that revenue is going to go from 15.7 billion trailing 12 months through September of this year, and it's going to grow up to almost 40 billion over time. That's a cumulative average growth rate over the next 10 years of 8%. Okay, so let's move through the rest of the operating assumptions. EBITDA margin I'm going to leave as is. Lam Research has done a great job of increasing their EBITDA margin over time. You can see it in the charts here. Now if I go down to EBITDA margin, I can see that 8 or 9 years ago they were at 11 and 12% margin, and they scaled that up to 30% over time. So what I'm going to do is I'm going to let it walk back down to more of an average level over time. This is a conservative assumption, and they may be able to continue to scale it higher, which would only be upside to the forecast. So back to the model. The only thing I'm going to change in the operating assumptions is the deferred tax. I'm just going to make it 0. I just don't want any noise. And that's going to leave me with a 14% tax, which has been historically what they paid and also what they paid last year. Down into the free cash flow section, I can see that Lam Research is a very capital light business. They've got about a 10-to-1 operating cash flow to capital ratio, which means that they don't have to invest heavily into PP&E to run their business. Down into the sources and uses section, Lam Research pays a fairly small dividend. They've got a dividend yield of about 1%, but they've been growing it fast. They've been growing it at about 27% a year. So I'm just going to leave that flat. I'm assuming that Lam Research is going to want to scale up the yield in their dividend and grow it quite fast, given the likely cash that they'll generate, and they'll be able to do it. I mean, they have no debt. The only thing that they might want to do is, instead of increasing their dividend at that rate going forward, maybe they instead increase their buybacks. That gives them a bit more discretion over how much they return to shareholders and allows them to be a bit more opportunistic with that capital in the market if their stock price happen to be lower. What's nice to see about this company is they're not acquisitive at all. They haven't done any acquisitions. So that means that all the growth in their revenue is completely organic. They're finding ways to deploy capital internally in lucrative projects, and they're able to win contracts and scale up their business organically. It's fantastic. Okay, and then if they pay that dividend and they do that level of buybacks, they're still going to put cash on the balance sheet. So this company really has no problem. It is truly financially sound. So what does that mean in terms of an expected return? Well, if the revenue forecast comes true, the EBITDA margins come true, and the exit EBITDA multiple I've assumed here of 15 times comes true, that means I can go into the market today and buy one share of the company at around $600. I hold the stock for 10 years. I collect the dividend that's going to grow in this forecast anyways at 27%. And then in the future, I'll be able to sell the stock at $1,600 a share. If you did the math on that, that's a 12.8% compounded rate of return over that 10-year holding period for the stock. And now it's always good to model the downside. The big drivers of that internal rate of return number, of course, revenue growth and the exit EBITDA multiple that I'm assuming. So to be conservative, I'm going to say that it's 14% next year, which I already know. They've already guided that number. Let's say they grow 5% the year after and they scale down to 3%. Okay, so that's an 8.4% return. Why don't we also drop this down to 12, which is more in line with their 5 to 10 year forecast. With an investment in Lam Research, even at $600 a share, under these rather conservative assumptions, it's still probably a market return. So it's my opinion that this stock's still a buy at 600, so long as the holding period is long enough. And there you have it, folks. That's Lam Research. I think a company like Lam Research is a good example of a fair-priced company that's financially sound and might be a little bit underfollowed. You know, they don't actually have to advertise, and the business they're in is also kind of complex, so it's hard to understand for the average person, including myself. If you like this type of content, please make sure to like the video and subscribe. I'd really appreciate it. All right, well, thanks again. Bye for now, and I'll see you in the next one.